Good afternoon, ladies and gentlemen. Welcome to the August 11th, 2020 market update from Gordon Asset Management. First off, disclosures. So this presentation today is for educational and entertainment purposes, not to be misconstrued with any investment advice or any recommendations to buy or sell any specific securities. As always, you can follow us on social media. We post all our presentations on YouTube. So if you'd like to watch any prior versions of the market update, feel free to just search Gordon Asset Management there. Today's speakers, actually, it's only me, Todd Zempel, today. I am Executive Director of Retirement Plan Services for Gordon Asset Management. Glenn Moore intended to join today. However, we had some technical difficulties. We're planning on getting him on the next week's broadcast. Quick coronavirus update. So U.S. COVID-19 cases rose from 4.7 million last week to just over 5 million this week. Current hospitalizations actually decreased a little bit, down to 49,000 from 53,000. Deaths did climb about 7,300, which is negative, of course. But the overall death rate continues to decrease and has decreased week over week. The big news that came out last night is apparently Russia has some kind of coronavirus vaccine, and Putin's daughter apparently has taken the vaccine. So markets rallied a little bit on that news today. However, there's still a lot of question about the validity of that vaccine. Also in the U.S., we continue on with trials over various companies are with their vaccine development. So we continue moving forward, but coronavirus still has a lasting impact on the economy. So until that really gets resolved, this is the big 1,000-pound gorilla in the room that we have to deal with. On unemployment, U.S. unemployment improved slightly. So unemployment, there's now 16.1 million unemployed this week, 16.2 last week. So slight improvement there. The big news here is that initial claims for unemployment fell to 1.18 million, down from, 1.18 million, down from 1.43 million last week. So that's good. Things are trending in the right direction there. And then the overall unemployment rate decreased to 10.2%, down from 11% last week and 14.7% at the peak back in May. Other news that came out this week, so this was actually fresh off the press today, producer price indexes rose by 60 basis points, or 0.60% seasonally adjusted for July. What's interesting when we dive into the numbers, and again, these numbers just came out literally an hour or two ago, so this is sort of fresh off the press, hadn't had a chance to really dive in too deep yet, but nearly half of the July increase for processed goods can actually be attributed to a 31.3% increase in the price of diesel fuel. Conversely, when we look at unprocessed goods, so crude petroleum actually decreased 13.6%. So kind of an interesting mixed bag of oil and fuel related data there. One of the other interesting things that I thought jumped out of the page at me is raw milk was actually up. Prices raw milk actually up 43%. When you look at the chart over to the right, you can see producer price indexes are still below the norm on a year-over-year change basis. But as you can see, when we've had prior recessions, producer price index tends to drop and then rebound pretty quickly. And what we're seeing right now is somewhat of a rapid rebound off the low. So this is something we're keeping our eyes on. It's potentially some of the first signs of inflation post massive money printing and really a 25% increase in the monetary supply here in the US. So international markets, when we look at foreign developed markets, they rose just under 1%, but still down nearly 9% year to date. Emerging markets also rose 0.77%, currently down 2.5% year to date. And the big trend there is really the drive in emerging markets e-commerce companies. So that's the e-commerce emerging markets companies have really been a key driver in the performance there. Then when we look at global bonds, they were up slightly, 34 basis points, currently up 6.21% year to date. Again, the thing I always tell people when they look at this chart, you can see the massive sell-off that happened in the equity markets. We also had a slight sell-off in the bond market as well, but if you had a diversified portfolio, that'll help buoy you when really bad things happen in the market. Here in the U.S., S&P gained 2.43% and is currently up 4.41% year to date. So that's a very positive sign. We started to see a little bit of a rotation out of the mega cap tech stocks that have really been driving the market. The Nasdaq actually lost week over week, just about 0.5%, but at the end of the day, it's still up 26%, which is pretty darn good by any stretch of the imagination. Russell 2000 small caps, they were the big winner, up 4.67% week over week, yet still down over 5% year to date. One of the things that we have mentioned several times over these webcasts is that we're looking for greater market breadth. So not only do we want to see the big Apple's, Facebook, Amazon, Netflix, Google, Microsoft's of the world, we want to see those companies grow, but we also want to see smaller caps. And typically when we've had recessions in the past, smaller companies have led us out of the recession. This recession was very strange in that the mega cap companies actually were the ones to lead us out thus far. So positive signs there in that we're seeing some gains in small caps. The Barclays Ag, so bonds, U.S. bonds rose slightly, up 7.78%. Again, this is the reason you have a diversified portfolio. Bonds will tend to hold their water better when bad things happen than the equity markets will. As I mentioned, we're starting to see more breadth in the market. The big winner in terms of sectors in the United States was industrials last week. It was up 8.49%. The industrial sector was up 8.5%. Financials also rallied 6.83%. There's a lot of questions about how financials will perform when we have very low interest rates. There's not a lot of interest rate margin to be had when real rates are near zero. But we've seen gains in financials. Financials really many financials are still down big year over year. But I think some folks are starting to eye that sector as a potential area where they can buy some value, lower price to earnings, so to speak. Energy also jumped up 6%. The three losers week over week: real estate down 0.7%, technology gave up about 0.5%, and utilities were down slightly as well. So this is good. Starting to see a little bit of a rotation potentially. We'll see if this holds up over the long term. We've talked about this slide a number of times in the past as well. So this is the disparity between cap-weighted and equal weighted indexes. Meaning cap-weighted index, they're more of the index is made up of the larger companies, and that's how the S&P 500 and the Nasdaq operate. The bigger market cap of the companies, the bigger share of the index that company makes up. Equal weighted just equally weights all the 500 companies in the S&P 500 index and the 100 companies in the Nasdaq index. We've had this major disparity between the cap-weighted index and the equal cap-weighted indexes. So the Nasdaq cap-weighted index substantially has outperformed the equal cap-weighted Nasdaq index. The same thing with the S&P 500. But we're starting to see a little bit of a change, particularly in the S&P 500. So the equal weighted S&P 500 actually outperformed the cap-weighted index by 180 basis points week over week. So again, that's some of that breadth that we're looking for to pull the broader market higher. So that's a positive sign as far as I'm concerned. To take that one step further, when we look at the largest companies in the S&P 500 index, Apple, Microsoft, Amazon, Facebook, Alphabet, again, like I said, they are the companies that have been driving the returns in the market, especially the Nasdaq, but very much so the S&P 500 index as well. You can see this is a chart over the last week. Facebook was the big winner, up 6.25% on the week. But really, most of the other stocks actually performed in line with or slightly underperformed the broader S&P 500 index. And so this is, we hadn't seen that much yet this year, but we're starting to see it now. So again, that's potentially a little bit of a rotation out of some of these big growth stocks into value, which potentially could be an interesting investment thesis as we go forward. Rates, gold in the markets. So the price of gold has been just on an absolute tear this year as the U.S. has expanded the money supply and have kept interest rates low, and some say potentially even artificially low. To us, when we look at the markets, a lot of the market returns have been just driven by liquidity in the markets. Easy money. It's easy to get loans. The stimulus, the government keeping some of these major companies afloat. So this is a trend that we'll continue to monitor. What's interesting is when you dive into some of the details of the data, you would expect that if we expand the money supply by 25%, which we have year to date, that we would expect to see a little bit of inflation. Those producer price index numbers that we talked about earlier, we're starting to potentially see some of the beginnings of inflation, but we really haven't seen it much at all on the consumer side, which isn't totally unexpected because we really don't actually see major increases in the consumer side of inflation, actual prices you're paying at the grocery store. Those tend to show up later in the cycle. Those are lagging economic indicators, whereas things like the price of gold are potentially a leading indicator. So this was one area that Glenn wanted to focus on, but unfortunately he wasn't able to join us today. So we'll glaze over this topic briefly today in hopes that next week he can join us and go into a little bit more detail. So the major themes we're watching, again, the dollar, interest rates, gold, any new stimulus efforts. We're currently battling that out in Washington, D.C. right now. For the most part, everybody thinks that, yes, we're going to get some type of additional stimulus and assistance. President Trump signed a series of executive orders. However, there's many questions on if that was even legal to do. So that's all playing out. I think that there's enough common ground that we'll come to some agreement. It's probably going to be more money than what the right wants to spend, and not as much money as the left wants to spend. And there's a lot of areas being battled over, specifically over some of the stimulus and assistance for states. So we're watching that closely, along with the election and continued unrest, social unrest. Market breadth, as I mentioned, we're starting to see the market improve in various sectors. So that has been positive. Keep an eye on that. Also, COVID-19 developments. Again, I think I mentioned this a few weeks ago. In my opinion, if we have any major developments in terms of any kind of reasonably successful vaccine or therapy, the markets are probably just going to go off to the races. If we don't get anything and things just continue to muddle along, that's probably the key driver, and maybe keeping us kind of where we are, and maybe laterally moving or even pulling back some in the markets. and also corporate earnings. So earnings, kind of a mixed bag, some better, some not as good, but we'll continue to keep an eye on that. Obviously, right now, when price to earnings ratios, a measure of the value of a company, are at all-time, well, not all-time highs, but near all-time highs, 2 times standard deviation above the norm. If we can increase earnings for companies, then that will bring down that ratio and things will be more affordable in relative terms. So that's something we're also keeping an eye on. That's it for today, folks. Thanks for joining us. If you have any questions, feel free to email us, info@wealthqb, or give us a call, 866-216-1920. If you're a client of the firm, have any questions, feel free to reach out. If you're a friend of the firm and you'd like to engage us, we'd love to have you. Thanks a lot, folks, and enjoy your day.